Yeah.
For joining us today. Um, as you may know, like we usually host more like financial related like talks with speakers, but me and Louis in the back, he's the other co-founder. We thought this would be a great experience to talk about more of the social impact and how we can actually do good. So whenever you
Yeah.
want.
Thank you. Thanks so much for inviting me and really huge congratulations on building this. I think it's a really interesting space. I admire that you're creating this space to think about finance, not just as markets and returns, but also something that really shapes, real lives and systems. And I'm really looking forward to this conversation. But because I think you're at a stage where how you learn to think about investing will matter more than, just one single school of thought. My work sort of sits around sort of investment decisions. So I work on questions that come before and after capital moves. So I'm asking questions such as what problem is this capital trying to solve? What outcomes are being created? For whom are we creating these outcomes and at what cost? And how confident really are we in those answers, right? So today, obviously, I'm not here to tell you how to invest because that's not my place, but I'm here to sort of show you how impact investment actually works when it's done seriously, how we can look beyond narratives, beyond values, and beyond sort of glossy annual reports, because that's the whole point, no? So, a little bit about myself. I grew up in India where inequality isn't something you read about in books, it's something you navigate on a day to day basis. You see economic growth and deep exclusion right next to each other, or you'll see modern infrastructure next to fragile livelihoods. So, what stayed with me isn't just that inequities existed, but that they were persistent. And this persistence actually tells us something very important that, societal problems, economic problems are not accidental. They are produced and reproduced by systems, incentives, and capital flows, right? And this realization sort of planted question that has shaped my entire career. Why do well-intentioned efforts so often fail to produce durable change? And that's sort of the question that led me to pursue masters in economics. And this economics sort of gave me a language for incentives, for trade-offs, for resource allocation, and it taught me how decisions should work under certain assumptions, right? But what I realized very soon was that what I learned in economics was great models, but they don't really, work on the ground. And therefore, theory wasn't just enough for me. I wanted to see how decisions were actually made in practice. And that led me to work with the government of India, especially the Ministry of Finance and the Ministry of Statistics, on a couple of independent research projects, mainly related to financial inclusion and access to sort of essential services. And this was sort of my first exposure to decision making at scale. And what I learned was really humbling because I learned that public policy can reach millions, but it is also constrained by politics, by capacity and time, which I think you've now individually, you will all have experience of that, from your own sort of exposure to public policy. And so then I began to ask questions such as if the public sector can't do this alone, and if markets don't solve problems by default, where can capital actually fit in? Private sector capital actually fit. So to explore that, I moved into the private sector and I started working as a researcher or a consultant at this organization called Frost and Sullivan, which is a growth consulting sort of company. And I really started seeing how investments in emerging markets were evaluated. So you look at market size, you look at scalability, projected returns, risk profiles. Um, Again, here I'm not allocating capital, but I'm very close enough to see the logic behind investments. And I noticed something very prominent and consistent that capital only flows towards what is legible, and by legible, I mean what is measurable, what is predictable, and what is scalable or replicable, right? But the problem is many social problems, especially problems that matter more, are often complex, they are slow moving, and they're context specific. And this sort of creates a structural tension. Um, because the problems that matter most are often the hardest for capital to see. And this sort of tension defined my entire career. And it sort of never left me. It hasn't left me. And because that sort of motivated me to pursue a master's in global affairs at the University of Toronto. So I worked on my second master's because I wanted to understand problems from a more sort of global lens, look at problems from multiple different sectors, and really see how investments can fit in within this narrative. So whilst doing my master's, I had an opportunity to work with the United Nations International Organization for Migration, IOM, here in Geneva, and specifically work on ESG and due diligence risk assessments, especially in fragile and sort of conflict affected settings. This for me was a turning point because I saw very concretely how one single risk flag can actually redirect millions in funding, or like a weak governance score, like an ESG, environmental social governance. A weak governance score can actually block partnerships, or a lack of data can actually exclude entire regions from investment. And that's crazy when you think of it. So this is where I understood something fundamental. Measurement of risk or impact doesn't just describe reality, it actually reshapes and influences where capital is allowed to go. So again, here I'm not investing, but I'm shaping the conditions under which investment actually happens. And this question of accountability, right? So what are the outcomes, and why, the how, that those questions around accountability actually led me to Reach Alliance, which is sort of like a research think tank within the University of Toronto in Canada. And there I led evaluations of sort of impact focused investments across multiple different countries, across different thematic areas. So we would travel to countries like Tanzania and assess, public private partnerships within the Ministry of Healthcare and sort of local community healthcare workers in Tanzania, and see how, if they partnered with, say, Coca-Cola and use the cold storage, bottling technology and cold storage system, how can you deliver essential healthcare to remote Tanzania? So those sort of, interesting projects, we would assess, and this is where we would sort of break down on a couple of our illusions, because we were not asking if this project ran. We were not asking if, was the money spent or the budget spent. We were asking, did outcomes actually improve on the ground? For whom did these outcomes improve? And what would have happened if this intervention was not in place? So we're really trying to ask those deep questions about impact focused investments. And what we found was that some interventions worked, but they only worked under specific conditions, or that some interventions you can scale, but they lost effectiveness as soon as you scaled them, or some looked successful on paper but changed very little on the ground. And so this taught me a very hard lesson. Without outcome evidence, capital cannot learn, because capital cannot improve. And if capital cannot learn, then investments keep making the same mistakes again and again. And that's when you see a lot of these investments actually failing and fizzling out. So this sort of impact measurement mentality or mindset really took me to Sustainalytics, which is basically, how do I say it? It's now owned by Morningstar, which is like a capital and risk ratings agency. And I worked specifically on ESG and impact reporting. So impact reporting, actually, when done seriously, it's not just a communication exercise, it's an investment infrastructure. Because at Sustainalytics, I worked with private sector organizations that actually wanted to demonstrate impact, and they were struggling, with all these frameworks, indicators, lack of standards, and not unclear sort of expectations. And they were really struggling with not just measurement, but also clarity in decision. So what do we actually measure? That's something that they were struggling with. And what outcomes matter most to our investors? So if I'm going to a funder, what outcomes is that funder really interested in? How can we, how can we choose outcomes that would actually change capital allocation, and how can we really double down on this? So this is where impact investment starts to intersect very deeply with impact measurement. And in practice, investors actually use impact data to answer three core questions. One is, this model fundamentally sound, right? Impact data can reveal whether demand is real or subsidized, or outcomes improve with scale, or whether they fizzle out, or operational complexity is manageable. And this directly affects risk assessment. Two, is impact being used efficiently? This is where impact per dollar matters, right? That's the most exciting question. I'm sure you've all probably learned in your classes. Um, Impact per dollar is not just a formula, but it's actually comparative lens, right? Because are we getting more outcome per unit of capital here than elsewhere in another project or another theme or another geography? And this sort of shapes your portfolio choices. Third question is, are our assumptions holding, right? Impact data often reveals really uncomfortable truths. It reveals whether growth dilutes impact, or it reveals that certain populations are actually hard to serve and harder to serve than we expected them, or that unit economics doesn't improve with scale. And so this also affects which investors exit, which investors actually continue, or which investors actually restructure their decisions to invest in a certain idea. And as I did more of this work, I started realizing that, there's a huge gap where early and medium stage sort of enterprises are struggling to assess, what to measure in terms of outcomes, and how can I present to my funder or investor about my business model. So I started advising early and medium stage enterprises independently, and I started seeing and helping them sort of embed impact logic into their business models, not just as an afterthought, or not just as like a fancy tick off thing in your annual report. No. So this experience fundamentally shaped how I saw impact investing, because I saw it as a discipline of learning with capital. Um, and I think it's all about outcomes. It's not about outputs. The first, we need to move away from asking how many people was this investment helpful in serving. We need to talk about what outcomes are we trying to change. Is this the right outcome? And this matters because outcomes define what success looks like. It matters because outcomes determine what gets measured, which outcomes shape incentives inside organizations. And therefore, choosing the wrong outcomes can actually lead to massive investment failures. And we also want to, ask questions about how confident are we that this outcome is attributable to the intervention. So if you were to invest 100 million in a project, would impact happen because you invested in this project, or would that outcome happen even otherwise without this project? So we talk about contribution, and we talk about counterfactual. So what would have happened if this intervention was not in place? So, investors don't just need proof, they need credible sort of learning signals, right? And then the most exciting investment question, which we spoke about earlier, which is impact per dollar. How much outcome am I getting per unit of capital? And this is where sort of opportunity cost, I'm sure you've all learned in economics about our opportunity cost. So this is where the opportunity cost concept enters. Portfolios get shaped and tough choices are being made by investors, because impact per dollar is not about ranking, lives. It is about allocating scarce capital responsibly. If I invested in X project, I am not investing in Y project. So it has to justify my investment in X project. And that's why this calculation is important. And then finally, most practitioners, at least on the field, they start weighing the trade-offs, right? So are you looking at scale versus quality? Am I looking at efficiency versus equity? Am I looking at financial sustainability versus depth? And so the goal is not to eliminate these trade-offs. It is to really own them. It's to reconcile with these trade-offs. So all of these questions that I've been talking about, whether it's outcomes or evidence or impact per dollar or trade-offs, these are not theoretical for me at this point, because they're very much alive in my current work at the Schwab Foundation for Social Entrepreneurship, and we sit at the World Economic Forum. And at the Schwab Foundation, we don't approach impact investment as a single asset class or like it's a neat category. We work at a very high ecosystem level. So on a daily basis, I'm working with social enterprises, public sector innovators, corporates, and sort of collective initiatives. And I'm trying to see what connects them is not sector or structure, but actually the nature of the problems that we're trying to solve. So I spend a lot of time actually slowing down this conversation around capital. So instead of starting with how fast can, this scale, or how investable is this, or what's the return profile, I'm actually starting with what outcome is central here. Let's talk about outcomes. What assumptions does this model make about people, system, and market? So, under these assumptions, this intervention will actually function. So, let's talk about what are these underlying assumptions, and then what evidence would actually change how capital behaves, right? So, if X output did not happen, or if X outcome did not happen, how can then we reallocate our capital, and how fast or slow will this capital move? So I thought we could talk about a couple of, but I want to test, like, is everyone bored? Are you looking at your watches or phones? Okay. So I thought I could talk about a couple of anchor cases. Just, for you to, I'm curious to hear your thoughts on this. And this is basically, these are cases from the Schwab community, and they are all 2026 awardees of the Schwab Foundation for Social Entrepreneurship. We do our awards every year. So these three cases are all awardees for this year. And so they're not just success stories, but let's use them as sort of let's workshop this out and, see whether they are decision making laboratories. You had a question? Is that why you're raising your hand? Okay, sorry.
Yeah.
Go ahead.
So let us know if you can't hear us well, but
I can hear you a little faintly, but yeah, go ahead.
so before we move on to like specific cases, I was wondering how do you measure the output of impact, whereas like such a like maybe subjective thing, um, because like I think it's easier to measure, for example, returns, but what if you're how do you measure impact, especially if you're like a private company not fully focused on like social impact, like how do you measure that?
It depends on what you're trying to measure, right? For example, in the past we've assessed, we've had companies that are wanting to measure sort of environmental impact. So for that, you will have certain metrics. So you can look at SDGs, and SDGs will have a list of metrics, or you can look at the Global Impact Investment Network, the GIN, which will have like a list of metrics and KPIs in across different thematic areas. So if you're looking at environment, you'd look at, CO2 emissions, or you'd look at, if you're looking at a specific water related project, you'll have set metrics and KPIs for that project, and that's how you would measure. And nowadays we also have like benchmarks, so you can actually see what your competitor has achieved in those metrics, and then you can benchmark your performance to your peer groups, and then you can use that, like, I'm doing better in ABC areas, and compared to the rest of my, peer group, I'm doing better. Or you can look at it regionally, or you can look at, so there are different ways to measure impact and demonstrate that impact. Okay, so the first case I wanted to talk to you about was this case called Drink Well. Okay, and it's founded by Minhaj Chowdhury, and they work on sort of providing safe, affordable drinking water in Bangladesh, and they're now also expanding across South Asia. You can check them out. At first glance, Drinkwell actually looks like a very clean impact investment case because water is essential, the health link is obvious, the need is enormous. And so what they do is they provide water. They have like ATMs for water, and people can actually pay money, and then, you get water, especially in water scarce areas. When you look closely, especially the way like sort of investors and practitioners like you will have to look, complexity of this case in Drinkwell actually emerges very quickly. So Drinkwell operates in contexts where public water infrastructure is weak or it's unreliable, and households already pay for water, but they're often paying for unsafe, sources of water. And then there are governments and utilities and communities all playing a very complex, intertwined sort of role. So Drinkwell's model actually blends technology, it blends local partnership and public-private collaboration to deliver water that is safer and more affordable than existing alternatives for the community. And now here's where sort of impact investing thinking really begins, right? Because we want to start asking about the outcome. The first question I'll ask is, and the first question most investors will ask, is what is the primary outcome we are trying to optimize for? Is it reduction in waterborne disease? Or is it affordability relative to household income, or reliability of supply over time, or you want to move away from unsafe sources of water? Like, what are those key sort of outcomes that we want, impacts that we want to achieve? And each of these is a legitimate outcome, because you cannot optimize all of them equally. So what you'll do, you'll assign weights. Perspective, the core outcome is sort of sustained access to safe water at an affordable cost, right? That's the umbrella outcome. And that framing sort of matters, because immediately it shapes what gets measured and therefore what gets funded. And then this is where sort of impact measurement stops being about reporting, but it actually starts being about capital discipline. So if you only measure number of households that were served or liters of water distributed, you miss critical questions that investors actually care about. So, do households continue using this service 6 months later? So, that's the durability aspect of this investment. What percentage of income does water cost over time? Or does health behavior actually change because now you're providing cleaner sources of water? And so, therefore, some impact data here can inform whether demand is real or artificially sustained, or whether subsidies are actually masking viability, or whether scaling improves or worsens outcomes, right? So, this is in risk information. It's not just impact information, but also risk information. And then now we get to a very sort of investment relevant question, our favorite question, which is impact per dollar. What does impact per dollar mean here? It can mean cost per household with sustained safe water access. It can mean cost per illness avoided, because waterborne diseases are a huge thing in that geography, or cost per reliable service point maintained over time. So what matters is not just this number itself, but how it compares to alternatives, right? So if you're looking at alternatives such as tanker water or bottled water or untreated sources of water, that's when this cost becomes not just a monetary value, but also like a in-kind value, right? This is where capital decisions start to differentiate between models that actually feel impactful and models that are structurally very effective. And so some sort of trade-offs that drink well as an enterprise has had to reconcile with has been scale versus equity, right? Serving denser population improves efficiency, sure, but it also risks excluding hard to reach households in remote, less dense areas. It has to look at affordability versus financial sustainability, because prices that are too low undermine operations, but prices that are too high undermine impact. Thing is, it has to look at rapid expansion, which can bypass public systems, but for long term resilience, you need public systems. So, from my perspective, I think these are sort of trade offs that are not meant to be solved, but these are trade offs that you need to make your choices consciously with. So, now that you've heard what I think about it, I'm interested to hear from you. What sort of outcomes would you look at? Give examples.
Well, you said the example of like how targeting a more like dense population would definitely like most people could benefit from that, but you would have the trade-off of leaving like more rural households without water. So I would when looking for an outcome, I would look for like how can I benefit the most people with the same amount of capital.
So, then how would you answer the question of investing in a water ATM in a rural area where the scale of operations and the cost of installing would be much higher? There's no wrong answer, okay? I'm just like trying to hear what your thoughts are.
I would focus on more dense populations to justify the capital.
Okay, so you'll have like a parallel operation where you would use the returns from the dense population investment in the less. Is that what you're saying? Okay. The world is in better hands. I'm confident because of you guys.
Considering that maybe this is outreaching, but considering that this could help more dense populations, maybe when these people are helped, they could like it's kind of like the multiplier effect,
Yeah.
how benefit more rural spaces.
Any other thoughts?
How do you tackle the ethical and like moral, like problems when because with all these trade-offs in impact investing, how do you tackle that?
Ethical. Can you give me an example of how you define ethical?
Well, like with this example here, like if we were to just give the water to like the dense population, then the
Mm-hmm.
trade-off is that we're not giving that service to like more rural populations. So
Mm.
like there's obviously like it's more optimal to help dense populations, but you know there's like an ethical
Yeah,
issue.
it's true. There's an ethical dilemma because you have to justify why you're doing it in a certain geography versus not in another geography. But I think you can justify it by saying that the goal is to make it more inclusive. And that's sort of like your North Star, right? That's your blueprint. You want to reach that objective. But to be able to reach that objective, you need resources, you need capacity, and you need sort of wherewithal to be able to implement in those areas. And in order to do that, you need money. It's like I want to buy a Porsche, but I don't have money. So I'm going to do Uber Eats till I'm able to make the money to go to Porsche. So it's not the best example, but I'm just saying that, you need to invest in areas where you can justify the returns. And once you are able to have the capacity to reinvest the returns that you're getting, you're able to then justify so the ethical dilemma then becomes you're converting that dilemma into a more tangible outcome and a plan. So that's the only way forward. You have to justify it economically, but you also have to use that justification to then say that this is ultimately going to meet a social objective.
What about in examples like if you were to like create like a water plantation to like extract water, something like that, like you're like essentially destroying like the environment. So
Yeah.
how do you like balance like you know like balance like environmental sustainability with like uh
It's a difficult question, and I think that's also why a lot of investors or people who pitch ideas fail because they're unable to translate the environmental, like the public good aspect of it, with the environmental thing. And I think the one way to do it is to become very, very objective. That if I'm going to destroy water resources, but it is ultimately, the perfect example for this is mining, right? How do people just justify mining? Because mining is it's a controversial activity, but how they do it is they say, I'm going to give livelihood and jobs to so many people within this community, I'm going to develop this community. So that is how I justify the negative impact of my operations and activities by what do you call it, compensating it with a positive sort of intervention. So I would say I would invest in schools and hospitals and building an infrastructure that will then uplift the community, which otherwise wouldn't have happened. So you kind of show that additionality by showcasing how you're reinvesting that negative and translating it into positive. Does that make sense?
yes. Yeah.
Okay, I'll maybe talk about one case because I think that's an interesting case. This is a case called Pad Up Creations, and I feel like most of you should check it out. It's founded by Olivia Onyemaobi, okay, and it's based out of Nigeria. And what it does is it addresses period poverty. And it doesn't really period addresses period poverty doesn't really capture the full picture of what they do, because their work sits at the intersection of girls education. So what they did is they realized a lot of girls were missing school in rural Nigeria because they did not have access to sanitary napkins. And so their work now sits with providing biodegradable and sort of reusable sanitary products with the help of local women and community sort of distributors, often through women who can earn income as micro entrepreneurs, right? So their work now sits at the intersection of girls' education, women's health, livelihoods for rural women, but also because they are using biodegradable sort of products, it also taps into environmental sustainability. So at first glance, this case looks like multiple impacts, and multiple impact pitches, stop here because impact investors at least require something harder. They require prioritization. So we were talking about how you would prioritize, right? So the first question if I were an investor, I would ask, if I had to choose one outcome to anchor this entire model, what would it be? Right? If you ask me, I would say it's girls staying in school For me, that is the most impactful outcome, right? Why? Because it integrates health, dignity, and opportunity, but it also has long term economic and social implications because girls are now getting educated that will then convert economically into some value add to the society. And then it is measurable in ways that matter for education, for learning, right? So this choice doesn't dismiss other outcomes, because I'm sure there are other outcomes that, Olivia must have thought of when she started this. But it sort of disciplines the model. By having one anchor outcome, it helps you sort of, you can use that as an anchor to justify your other outcomes. It's like a starting point. So once that outcome is clear, then measurement becomes a sort of a design tool, right? You start asking, are school attendance patterns actually changing because of my intervention? Or over what time horizon? Or for which age group, And in which context does this model work better or worse? So I think this information really matters enormously for investors. And you'll see once you all start getting employed, you'll see they'll ask questions about where capital should be concentrated, where adaptation is needed, where assumptions are actually breaking down. So measurement here is not about proving value, but it is actually about proving improving effectiveness. And impact per dollar in this case is so layered, right? It might include like cost per girl supported through a school year, or cost per sustained livelihood for a woman distributor, right? Because now she's getting employed because she's now associated with this intervention, or cost per avoided health complication because now you're providing sanitary napkins, lesser number of girls are falling sick and missing school and all of that, right? It's a ripple effect of outcomes and costs that you can assess. The danger is not in collapsing these into like a single headline number, but instead, actually, investors must decide which outcome of these outcomes they are primarily paying for, because that can help them sort of, okay, there are 10,000 outcomes here. Which outcome am I paying for? Is that outcome aligned with what I want to invest as an investor, right? Which outcomes are co-benefits? So if I invest in this intervention, I am able to achieve this primary outcome, but in addition, I'm also able to achieve this XYZ outcomes, which is great for me because then I can justify my investment. And which trade-offs am I actually willing to tolerate? So, oh, okay, there's a trade-off in scale, or if there's a trade-off in equity, how am I is this tolerable or is it non-negotiable, right? So those are sort of decisions most investors sort of make on the ground. And as exactly what I was saying, scale versus depth. So expanding rapidly may reduce, you know, the quality of service, or, the follow up, or, using cheaper products might be great for me for my cost, but it might undermine long term sort of adoption of my product. So these are sort of trade offs that you'll have to make decisions on. So from my perspective, what makes this an impact investment case is not that it avoids these trade offs, but actually it forces them out in the open. So like these are the trade-offs. You make that decision. You had a question?
Yes, in all of the projects you told us, they are more long term. So how
Yeah.
do investment investors like see returns, or how they?
For long-term projects, how do they see returns? Is that your question?
Yes, yeah,
Yeah, I think what they do nowadays is that they phase it out. So they'll divide it into different phases. The first 2 to 3 years will be like like a starting phase. And so in my starting phase, how do I define my key metrics for success? In the next 4 to 7 years, what phase should I be in? What stage of the investment should I be in? What returns should I have received? And then what sort of metrics am I measuring that
yeah.
success against? And then finally, of course, do you still need my investment, or are you now self-sustainable? So if when you divide it into different phases, it becomes easier for the investor to really see whether it adds value for them to invest in this stage or not. Did I answer your question?
Thank you.
Okay.
Yeah.
If you were to assess outcomes for this case, because it's a more social case now, what are some of the outcomes beyond the outcomes that I spoke about, or maybe you can repeat them, but what are some of the outcomes that you would think about? If you were an investor and if I were to pitch this project to you, what would be your first two questions to me?
How long are you have to look in the future, because let's say you fund a young girl, it's gonna take a couple of years until she actually enters the economy and the workforce. So
Mm, Excellent. Excellent. So this is why most people actually only fund, if you see, most people fund healthcare outcomes because they're easily measurable in the shorter term. But for anything related to education, and you'll see this once you start working, anything related to education, there's a certain amount of skepticism and hesitation to invest because the return on that investment will be at least 10 years. If you're investing in primary school or like any of these school kids or like midday meals or whatever, the translation of that into an economic value can only be done once the child moves out, right? It moves into the market. So this is an excellent observation. And that's probably, I'm sure Olivia must have struggled to sort of convert this outcome into an economic value. And she must have done a lot of calculation to justify the school aspect of it. So what she would have done probably is to translate that into a healthcare outcome. So now if less number of girls are missing school, that is because they are healthier. So if they are healthier, how can that then be translated into a healthcare outcome? So maybe there are different proxies that invest or like people who have ideas, entrepreneurs, they use because that's an easier way to explain return on that investment. Any other questions?
You mentioned that the women are becoming like micro entrepreneurs or
Mm,
getting paid in a certain way. So who's who's paying for those deliveries, or like if the young girls they're not the ones like buying the health products, who's
yeah.
paying those those like
Yeah, I think that the pads are definitely given free, of course, for the girls, and the young women. I think there's going to be a flow of. I was talking to an external partner today, and they were also mentioning initially there's always going to be a grant or a fund to sort of support this, and once it's like an engine, once it starts kicking off, and once it becomes sustainable, then you can pull out investment, and then slowly like the people who are involved in it start earning a percentage of income, and then that income keeps multiplying and multiplying, and that's how they earn. And then as you amplify cases like this, sometimes there's more grants that and money that pools in, and so then that then becomes their reserve fund.
I'm interested in like going back, um, how in India there's like a lot of inequality.
Hmm.
So how does like impact investing fit in there? Because like it's like not like such a easy problem. Like there's like a lot of like challenges to get there. So how would you
Y-
like impact
You're
investing?
talking about financially fitting in? Like how can you justify an investment because there is so much inequality and there's so much inequity, and therefore it becomes difficult for a for a project or an intervention to become sustainable. Is that what you're talking about?
Yes, yes.
So this is why it's important for more and more funders who are able to absorb the risk um, to fund these sort of social projects and enterprises, right? This is why now we are having these conversations with banks and with high net worth individuals who have the capacity to fund a massive amount, and it doesn't matter to them if the project fails initially because they have the capacity to invest. So we need patient, it's called patient capital, right? Because you might not see the results immediately. You might see it in the next 5 to 7 years. And that's primarily because of the inequality. And so you will have to put in effort to first bridge these gaps and divides, and only then will you be able to see the return on that investment. So you need investors who can actually wait patiently for the return on their investment to show. Does that make sense?
Yes. Thank you.
you mentioned how when you were consulting and overlooking this capital allocation, you really saw how some like companies that maybe didn't have the best ESG or like impact investing record, like deals were stalled and it really affected them. So
Hmm.
how is that influencing like companies nowadays? And do you think like it's something that like as investors we should really look into?
I think um, one is not having clarity in what you're asking for, right? That's at least back in 2015 and 2016 when I started off in this field, there was less clarity on what we wanted to measure, what problem are we trying to solve. So there are two types of investments, right? Or two types of enterprises. One is an enterprise that's just trying to get ahead of the game. Okay, so it could be like quantum and, all of these mega trends, right? The other is an enterprise that's actually trying to solve a problem. So for the person who's pitching this, they need to have complete clarity on what problem am I trying to solve, what difference am I making in this ecosystem. Without me, this ecosystem would function a certain way, but because of my idea or my enterprise, this is the benefit for this ecosystem or for the society, for the economy. I think as soon as you crack that code, it just becomes so much easier to talk to an investor. So tomorrow, if you become investors, as soon as somebody is able to convince you that this is the problem I'm trying to solve, these are the outcomes, this is how my intervention or my enterprise can actually bridge this gap, and this is the niche, it is so much easier for you to believe and see the long-term game for this investment and then invest, right? Versus if it's a person who's pitching an idea and they have no clarity on what they're wanting to do, versus, I just have an idea and I just want to do it, but there's no problem that you're trying to solve, or you're trying to solve a problem that doesn't exist. Those are some key sort of um, criteria that I think has changed over the last decade or so. Now, with more information and with more access to sort of metrics, and with more access to even education with MBAs and everything, people have now more clarity on what problems we are facing, what risks we are facing, and how am I trying to solve this problem. And they're now able to, because of networking and whatnot, able to create an ecosystem that can help them pitch that in a better way.
And have you seen that what I kind of also meant is, have you seen nowadays that like a bad ESG or a low impact record has affected a company itself, especially like the external factors?
Have I seen a company with bad ESG? Is that your question?
Yeah, like where a bad ESG or like a low impact record affects them.
Yeah, I saw this when I was trying to assess. As I said, I was working at IOM. I can't take the name of the company, but it is, I would say, an apparel company. And they had factories in Bangladesh and some other South Asian countries. And because of the lack of labor laws in those countries, they had some sort of unethical manufacturing practices, and that led them to have a very low S, in E, S, and G. It led them to have a very low S and very poor G score, and it actually resulted in us not partnering with them and not taking their donations because we figured that they had a very poor ESG score. And so then what we did is, now there are organizations like RepRisk and Sustainalytics. They actually conduct these ESG risk assessments, and then they'll follow it up with like a set of recommendations that you should follow as a company to improve on these poor scores. And that's how they can then become like, a better scoring. Or some companies decide to follow that, and some companies just go on as business as usual. And then eventually, sometimes I've also heard that they pay money to get like a better score, but I'm not sure if that's true.
Yeah, thank you.
I have a question. What's the rate of return that you look forward in a fund while impact investing? Like, what's the median you look for? Like, for the
Are you looking for a percentage?
Yeah, like what's the percentage?
I think that depends on the investor's priority, right? And the investor's ability to bite the bullet. So sometimes if the investor has the capacity to de-risk an investment, they are ready for a rate of return, say about 70%. But if you're going all in and you don't have much capacity to bite a failed investment, then you'd say I need at least a 92% rate of return, and I need 8%. Anything below or above a 10% risk, I'm not going to invest. So it depends on sort of the investor's capacity as well. I think it depends, because if it's a social enterprise and if there's government funding, then if that rate of return would be very different versus if it's a fully private funded hardcore sort of investment.
Yeah.
The last thing I want to share with you is actually, if I can share my screen, I'm happy to drop the link to this. It's basically, I mean, you can look it up too. It's a global risk report that was launched by the World Economic Forum last
Yeah.
month. I wanted to focus on this basically. This table talks about all the global risks that are ranked by severity in the short term, next 2 years, and in the long term, next 10 years. So basically, the global risk report is a survey, is an output of a survey that is done by the World Economic Forum every year. So it's about 1,200 global leaders and practitioners who actually rank these risks. So if you can see, sort of the risks that our generation is going to be dealing with in the next few years, right? So this is the sort of investment thematic areas that you may have to deal with in the next few years. And I think this report is important because of that. So you can see in the next 2 years, you will be dealing with sort of extreme weather events or misinformation, with all of these contexts around wars. There's a lot of geo-economic and geopolitical conflict. But I want to focus on the societal sort of these ones, right? So societal polarization, inequality, or like migration, displacement. These are sort of the key risks that I think once you graduate, these are sort of the investments that might come to you, or the pitches that might come to you to solve these sort of social problems. I think this report might be helpful for you, uh, just to sort of get a sense of what sort of thematic areas you're looking at in the next 5 to 10 years.